Now, as China's economy, that is the second largest in the world, continues to struggle, global markets remain jittery. Now, the downgrading of China's AA3 government bond rating from stable to negative, ratings agency Moody's highlighted a sharp fall in the country's foreign exchange reserves and a weakening in the Chinese government's fiscal strength. These were some of the main reasons for that decision. And Moody said it expected it to diminish even further. But joining us to discuss the impact of the Chinese economy, what this has had on global markets, we are now joined in studio by Dr Martyn Davies, MD of Emerging Markets and Africa at Deloitte Frontier Advisory. Goodness, we've got Jeremy Stevens. Let's get that right. He's from Deloitte Frontier Advisories and China economist at Standard Bank. And also we are now joined by Petri, Redelinghuys, senior trader at Inkunzi Wealth Group. Gentlemen, thank you so much for making the time to join us this afternoon. Thank you. Martyn, let me start off with you. What have been some of the biggest factors? Everybody's been saying, yes, China has slowed down, but let's take a step back and understand why.
Starting with this cover, China's zombie economy and empire stumbles. That's a bit harsh, but extreme. I think there's too much bearish sentiment around China currently. If you believe sort of the headlines, one would think China's in some sort of crisis, some sort of meltdown. Growth is still, we can debate the merits of where the growth actually is. Realistically, maybe, Jeremy, you'd say maybe 4 to 5 perhaps, arguably. Depends what sector you're in. But, you know, a 4.5 to 5% growth in the current global economy, it's no mean performance. So I think, you know, of course, I think what has taken us all by surprise is the rapid speed of China's rebalancing, so to speak, almost a recalibration of China's growth away from sort of infrastructure-driven, over-investment-driven economy, one towards more consumer spending-driven. And that's obviously had a very negative knock-on effect of us in Africa, and taken all African economies and particularly resource companies by surprise in this part of the world. But it's certainly not as, I think, as negative as many commentators tend to make out.
Jamie, do you agree? Are we being a little too harsh with some of the headlines around China? And is this just got to do with transitory effects?
No, so I'm a little bit more bearish than Martyn, but I suppose he guessed that. Look, I've been in China for 5 years. I've been following the macroeconomic story for those times. If you focus on the structural story, the data is all telling you the same thing, which is a significant slowdown in economic activity. Gone are the days of mobilizing mispriced resources, whether it's land, labor, and capital, and you can still continue to generate rapid headline growth. It's become more difficult, it's become more focused on efficiency. The problem is that over the last 5 years, what the lesson of the financial crisis was, if you were under-leveraged, you did better off. China was in that position, but subsequently since then, they've basically used credit and leverage to generate relatively stable economic growth that's continuing to slow down. And really, when you have mispriced resources, you have firms making decisions in the dark, you have banks allocating capital in an unproductive way. And so now China's dealing with falling productivity, falling returns, economic activity slow. Like Martyn says, it might be 4%, but in some geographies it's negative, in some sectors it's negative. And so there's more and more provincial risk, there's more and more non-performing loans coming onto banks' balance sheets. Very difficult environment for the Chinese authorities, and so that's really what we're seeing playing out.
Petri, you've heard what Martyn has said, a bit more bullish, bearish. How have global markets taken the news? How has all of this played out?
I think, well, I mean, I can't speak for all participants, but it's a confusing situation to try and understand exactly what is really happening there. I think, you know, as Steve points out, that the economy is slowing down, and what that impact has been on us is I think sort of the most obvious one, because we have a situation where we are exporting predominantly resources predominantly to China, and you know, our biggest customer is buying less and less of the stuff. So you know, I think that global markets, I mean, if you look at the US economy, they seem to be recovering fairly well. Europe seems to be in trouble, they're stimulating. China is factually slowing down. And you know, whereas the small emerging market economy we're sort of stuck between a rock and a hard place. Our biggest customer is buying less of our products, and this could potentially have very negative, you know, impact on our economy at large.
Martyn, let's talk about some of the levers that maybe fiscal policy or monetary policy can possibly play here. You are quite bullish, but is there room here for China to try and get things right? What can they do?
I think there is. Look, the policy committee meeting of the National People's Congress took place a month ago, early March. The target growth for this coming year is 6.9%, maybe nudging 7%, which is maybe overly optimistic somewhat from their side. As Jeremy said, perhaps in certain sectors, looking at consumer spending growth, it's still double digits. Consumer spending is 10% plus every quarter. We're seeing a massive contraction in traditional industries, think cement, steel, heavy industry and the like. But if you're looking at one of your beginning comments was around declining foreign exchange reserves. China still sits in about 3.2, 3.3 trillion US dollars. It has 20 months of, I checked this, 20 months of import cover, which is the world's highest figure of import cover of any economy. Second is Japan, which only has 14 months of import cover. So it's pretty, positive in that sense. China continues to run a current account surplus. So there's a lot more, I'd say, fiscal sort of runway, at least, for the Chinese government to exercise stimulus in the domestic economy. To anyway get near the 6.5, 7% or 6.9 official sort of target they're targeting, one needs to have very arguably potent fiscal stimulus, which I think maybe they won't be able to do that much. But there's certainly levers to pull there, particularly on the reserve ratio of banks, now 16%. They reduced that by 0.5% a month and a half ago. That freed $96 billion by some count, liquidity back into the economy, and that 16% is still quite high. The second thing we need to do is a more accommodative monetary policy. The challenges China has is, I think the black swan for China this year is rapidly depreciating currency. The government has been very sort of pushing the official line that the currency is arguably fairly valued, the downward pressures are perhaps too much, and the capital count is relatively closed, therefore preventing speculation. So I think, yes, the biggest challenge China has right now, and Jamie alluded to it, is the management of moribund, cash-sucking state-owned enterprises in traditional sectors. This is the cost of state capitalism, and China ultimately, like everyone else, has to sort it out. Sounds familiar?
SOE is becoming a problem there. Jeremy, we spoke about the monetary or fiscal policy responses from China. What we've seen in emerging markets versus developed markets, their response to what is happening here. And has it been appropriate?
What I've seen, is for 5 years China's undertaken some kind of mini stimulus package. Those stimulus packages have proven to be ineffectual in slowing and arresting the GDP growth rate. So China's nominal growth has gone from 20% to 5.9%. The only reason they got a 6.9% print last year is because they had deflation. Now those trends aren't going to go away. So we need to recognize that the way that China links to the rest of the world, which is what both of these guys are saying, has changed considerably. So volume of exports to China last year from the world were 0.2% growth. The year before were 3% growth. So China's buying less and less stuff. They typically, for years, they consumed about 50% of the world's commodities, but they accounted for 20% of the world's GDP. They were heavily reliant on fixed asset investment, which is becoming incredibly difficult for them to continue to grow. Last year, they built $8.5 trillion worth of new stuff. They certainly, at some point, are going to reach a top where that becomes negative. So that is going to affect their economic activity and how they link to the rest of the world. The problem is, a lot of the emerging markets had built their economies and their growth momentum around aligning themselves to what China was doing. So in Brazil, 2008, I was there, and everybody was talking about just exporting 20% growth of pulp, paper, wood, soybeans, whatever it was. And that's consistent with our clients as well. A lot of the optimistic forecasts in Africa for what we were expecting to see were built on these sort of linear outlooks for China. Now that's proven to be fundamentally misplaced. As a result, that's manifested in commodity prices in a material way. But what's striking, what Petri will know better than me, is that the traders in the last couple of months have been quite optimistic about China. So everyone that I speak to in China is bearish, but when I came here and sat on our trading floor, they're all like, China's doing pretty well. 6.5% target for the next 5 years, more stimulus, 13% growth.
Let's hear from Petri. Is that what you, and Petri has just recently come from New York, and I think he was also touching base with some of the traders there. Is that the sense that you are getting? People are a little bit more bullish on China, and given that, Jamie was talking about the fact that we've made some wrong policy decisions or some wrong calls for investors, safe haven assets.
We've sort of structured our entire sort of world around China never ending, and it seems to be doing that. The thing is, I think I'm fairly bearish by personality type. I don't think there's any reason. I've been biased and bearish since 2009 kind of thing. So
I relate to you.
Although the general feeling is I had the opportunity to sit at a trading desk in New York last week, and you say to the guys, this thing can't keep going up. Surely at some point we need to start considering, putting in a hedge or whatever the case is.
Yeah.
And the general feeling is that, the market's rallying and China's growing and there's no problems. And look, they're just stimulated and the markets are pushing.
Yeah.
But I mean, if you look at the equity market within China, it's like a roller coaster. It's been up and down. Last year it tanked 40% and it still ended green. So it gives you some sort of an idea of how strong that market rally was, and it smells like an asset bubble, to be honest, because a lot of these valuations are built on the back of property prices that were essentially built up and to try and boost the economy, and giant developments were done that are sitting largely unsold. And if that bubble bursts, banks have massive exposure to essentially property based derivative exposure, and if that bubble comes down, if property prices continue to decline, then I think that there can be a bit of a black swan event. It's going to be something that catches us all off guard.
I've got 2 minutes to get closing comments from all three, so I'm going to work backwards. So Petri, I'm going to start with you. If you have exposure to China in whichever form, do you stay as you are? Do you expand your exposure? Do you pull back?
It depends on I think it depends solely on your investment time horizon. Yeah, I think if for personally, I would cut exposure from China. If you are a long-term investor and you've got 30-year outlook or 30 years to go in your on investment horizon, then there's no reason to run for the hills. Over the long term, equity markets go up, and you'll be safe.
Cautious approach. That's never a bad thing. Jeremy?
So I've been talking to most of the commodity guys, and really a lot of them had sort of short commodities and they bought CDS spreads and they were protecting themselves for a fall and they got squeezed out. So this rally probably has legs because data probably improves for the next weeks and months out of China. The real story is volatility out of China is here to stay because the complications and the challenges facing the government are too interconnected, too complex, too multifaceted, and so policy choices will have unintended consequences. And as a result of those unintended consequences, there might be inconsistencies, inconsistency in messaging, inconsistency in different policy units, different divisions, and as a result, volatility going into the global economy out of China is probably going to be on a net basis for the next 2 years negative. That's my view.
Right. Martin, you've got the closing comment.
Thank you.
Yeah.
There's too much hypersensitivity around risk in China. I've been hearing about the Chinese collapse for the last 20 years and it hasn't happened. China's become arguably an external crisis-resistant economy, be it from 1997 Asian financial crisis, emerging crisis 2000, 2003 SARS medical crisis, 2008 Western financial shock. But China's growth has remained very robust. China's growth normalization is a positive thing. It's moved from quantitative headline growth, which has been very overinvestment driven, to a more qualitative nature of growth. That's very positive for China. The negative story, if you're in a resource commodity exporting country, I'm afraid it's time for plan B, and maybe that's too late. Last comment, I think even China at a pessimistic 4% growth rate is still adding more middle class people into its economy than any other economy, probably any combined right now. My last comment is you watch medium term, the demand shock in a positive way will still be coming out of China, and that will have, as Jeremy said, I think beyond a slightly short term because of this hypersensitivity of risk, but a very positive impact on the markets China going forward. I remain bullish.
Demand, watch out for demand shock.
The demand shock is coming from China in a good way.
We're going to be watching for that. Gentlemen, thank you so much to whisk through it. Thank you very much to Martyn Davies. Lini, thank you so also a very big thank you to Jeremy, let me get that surname, Jeremy Stevens, and Petri Redelinghuys. Thank you everyone.